afternoon and welcome to this week's edition of Halftime Talk. I'm delighted to be joined by Jarand Rystad, the CEO of Rystad Energy. Good afternoon, Jarand. Thank you for joining us.
Yes, thank you. I'm happy to be here.
It's been a pleasure and very much appreciated to have the chance to review your research and all the work you guys do and publish and provide to the energy markets. So thank you and for that and for making such a positive impact. There's many things we could talk about, obviously, at this very sort of special and strange time in the energy markets and the world in general. But I thought we'd start with a slightly deeper dive into the narrative that preceded the Ukraine crisis, continues to be of great concern and was articulated most recently last weekend by the Saudi and UAE energy minister, and that is the lack of capex investment that's gone into new oil and gas production, exploration and production over the last 5 years or so since the oil price crash in 2014-15. I wonder if you might give us your overview at this point, how big a factor that continues to be and what your outlook for that is.
No, I think that is the reason behind the current big kind of squeeze in the energy markets, especially on the oil and gas side, of course. Already the last fall, we saw the consequences of too little oil and gas in the market with the big increase we saw in the energy prices last fall, of course. And of course, when the situation with all the countries don't want Russian oil and gas anymore, of course, this is adding to the situation and creating the very, very high energy prices we have at the moment. But however, there are several elements here to be discussed on the narrative, because one narrative is that we have invested too little in the traditional large upstream oil projects, offshore oil projects, in the processing facilities for those all the time from 2015-16. So we have been underinvesting for like 6-7 years, because the global investments were more than halved from the peaks of 2013 and 14 and down to 15 and 16. So one point of view is that yes, we are now suffering from this long-term lack of investments. But the other narrative is actually that since the arrival of the shale revolution in 2010-11, actually the whole oil market shifted much more to the short-term investments in wells, especially infill drilling in the Middle East, infill drilling and other fields, together with the shale. And the shale added sufficient capacity to the oil markets so that it's more, the short cycle are more dynamic and are able to catch up within 18 to 24 months. And we don't really need those long-term investments anymore, because we have sufficiently dynamic situation with the shale ramp up.
Do you think that is a short-sighted view still? I mean, you can see how it infiltrated the thinking over the last decade running into COVID. But now, for example, with the windfall of income that the major energy companies have, literally hundreds of billions of dollars of revenue, and yet we're not seeing them move what you would expect, given the shortage of new capacity, given the sort of energy crisis, that opportunity or that emergency is not landing with the major energy companies. Is that short-sighted? How do you interpret the continuation of that thinking, even while we're in the midst of a big demand crunch?
Well, I think that everything shifted with the shale revolution, that actually the capacity of the short cycle was more than tripled globally. So meaning that if you're looking at new oil 2 to 4 years down the road, most of that new oil will be from the short cycle, meaning shale and infill drilling. And that we, to a lesser degree, need the big offshore projects that we would have needed if it was not for the shale. But of course, you have still very productive and economical competitive fields, for example, in the deep water Brazil or the new developments in the North Sea or in Guyana, etc. Those are absolutely competing. But overall, the shale put a clear limit of the need for these typically long cycle volumes, with 7 to 15 years development time, etc. So I think actually that we could see a global oil market back in balance already by 2024. Clearly, we will have a squeeze in 2022 and 2023. But towards the end of 2023, I think that the combined drilling of offshore shallow water Middle East, combined with the comeback of Iran, combined with heavy drilling in the shale in the US, however, not by the public listed company, but very much driven also by private companies there, which is less transparency around. Then I think we might see an oil market back in balance. So
you're not putting too much burden of responsibility or cause from the lack of investment or the change, as you'd said, due to the energy transition discouraging majors to spend that kind of investment into the long term, the long cycle, given the unknown and the precarious nature of the energy transition. Would you not put some causation there?
No, I'm not too strong on that. I think the key cause was, of course, that just 2 years ago, we had a negative oil prices for a short period. And basically, companies need to shut down whatever they could in short-term investments. And of course, the aftermath of that was that we had too little infill drilling in 2020 and 2021. So leading to this squeeze of available oil in the end of 2021, and as I said, further exaggerated now with the situation with Ukraine. So I think actually that what we're seeing now on a lot of other sectors is a speeding up of the energy transition. Of course, it's a race between what will come first, the peak oil and peak gas, and a decline based on these increased ambitions and extremely faster than expected pace of deployment of new renewable resources. Will that be there in time for the short cycle oil and short cycle gas to be sufficient to find a balance? Or do we need really a lot of long cycle investments also to take the market from the end of the 2020s?
Do you differentiate at all, or how would you sort of thinking differentiate between oil and gas on this issue?
Yeah, there's some clear differences. First and foremost, oil is a very global market. So with some exceptions, most oil will be traded globally. The exceptions are, for example, some of the refineries in Hungary and Slovakia, etc. They are really depending on one pipeline from Russia and is not really subject to kind of a global supply chain. But most of the other oil globally, you can take from one source if you don't get it from another source, even if it takes some time to adjust the refineries to new crude qualities, etc. But on the gas side, it's much more regional markets with less global liquidity, even if the growing fast growth of LNG is adding to the kind of globalization also of the global market. But there are more local issues on energy security, for example, related to gas, which is, of course, what we are seeing playing out in Europe at the moment.
I suppose the question really leads to that, as you just said, the current moment. Oil has its fungibility. It has its, maybe even, some will argue, we are entering the era of peak oil demand. Pre-COVID, pre-Ukraine, that was in the thinking, and certainly there are many that are arguing now some of the things we're seeing in China is peak oil demand. But what was also and is currently in the thinking is that peak oil demand gas is still some time away, and now with the crisis in Europe, perhaps even further. But the investment requirement now, I wanted to get your thoughts on Europe wanting their cake and eating it, so to speak. They're desperate for emergency gas supplies. Please, Qatar, please send us LNG, but only please send it for 5 years. The willingness of Europe to invest in the capacity it requires for energy security over the 20, 30-year cycle, where do those two go together, do you think?
No, I think Europe, I mean, the net effect of saying no, thank you to Russian gas will be that the gas consumption overall in Europe will be smaller, declining faster. But still, we of course have a supply gap that is quite severe over the next 5, 10, 15 years. Even in a declining European consumption, we see even faster decline of gas supply. So we really need all the additional supply we can get, and the bottleneck is the regasification capacities to Europe. So you know, the U-turn in the US Euro relationship in terms of long-term gas conversations is one illustration that Europe is doing everything they can to get short and medium and also long-term, if that is 10 years, gas supply. But as I said, the net effect is still, I think, a significant acceleration of the energy transition and the reduction of gas consumption in Europe. But
is this not a learning moment that the energy transition has got ahead of itself, that it isn't ultimately the solution in of itself, right? That the fuel mix that Europe had got, regardless of Ukraine, regardless of Russia, had got this projected transition, and Germany exhibit A on the commitment to transition and not being adequately supplied.
Just one step back. I think if you're looking at the three kind of elements of energy supply, you want secure supply, you want affordable, and you want sustainable.
Or reliable is another word, perhaps.
Yes. Secure. I mean, then I mean reliable or energy security. Don't want to run out of energy supply any weeks during the year, etc. And that was originally put up as a dilemma or a trilemma because yes, renewables were clearly the most sustainable supply, but fossil fuel was seen as the more affordable supply, and also maybe provide energy security, since it was a globally traded market that you could get access to energy, even if some domestic resources didn't deliver. But I think actually now that in terms of affordability and also energy security, renewable is actually now longer or out competing fossil fuel, but it will take time to bring all this infrastructure needed in place. So that's why we have another 1 to 2 decades where we really need all the hydrocarbons we can have also. And from a sustainability point of view, it's not a risk to invest a lot in the fossil fuel. The only thing you risk is that some of those infrastructure will not be utilized. And it's better than to have excess infrastructure than having lack of energy supply, you know. So that's why I absolutely encourage investments in also the fossil fuel value chains to Europe, to be able to supply Europe without Russian gas and oil, which is about 1/3 of the supply to Europe. So it is really.
Is the thinking shifted at all? I suppose that's what the point I'm trying to get at. Has Europe changed? I mean, we were debating only a year ago whether gas was going to be part of the COVID emergency spending package in Europe. Has Europe, on the back of Ukraine, on the back of Russia, in any way adjusted its mid to long-term thinking regarding fossil fuels, rather than it's bad, we want renewables only.
Yeah, they have. Because they took as granted a year ago that we will get the feed we need from Russia of oil and gas. And we have the Nord Stream 2 coming in, even increased energy security delivered from Russia. So we don't really need to bother about the fossil fuel. We take that as granted, and we can focus then on the green shift. Just now, when this is no longer the fact, then we cannot change all our infrastructure overnight. And also we want to have industrial production in many of these countries using gas as a feedstock. So that's why it's suddenly now become a very hot topic. And we need to increase investments in everything that could debottleneck non-Russian supply to Europe. So that's a completely new focus. And as I mentioned, with the new EU-US relationship also, that they want to, that we just now want to have long-term contracts to help US sellers of gas to take the decision to build the liquefaction facilities and transportation infrastructure and the import infrastructure, because we see that we need this for 10 years at least now. So it's more than enough time to pay back these investments. So this is, of course, a new shift. But the net effect is still that the gas consumption in 2030 will be smaller than it would have been, because we are, and you're seeing now a lot of initiatives taken in all the countries in Europe to faster get rid of the gas boilers in the basements of all the buildings, to faster build solar and wind capacities, tripled in ambitions on that, just published from Germany, just a few weeks ago, etc. And all of that, well, they will not impact the market the next 2 years, but it will impact the market significantly in 2030. So,
will Europe in general have to get used to? Of course, we're seeing very elevated energy prices now, but we were already seeing them a year ago in winter 2020, 2021. We've seen it again, obviously, 21, 22. Does Europe, it's all industrial, not only on a consumer base, but Germany, the manufacturing center of Europe and one of the biggest in the world, has benefited so greatly in the last decades from cheap energy and, to a certain extent, cheap euro currency. Will Europe have to get used to competing with a much higher energy cost base?
I think so, for the next decade. And as you say, Germany is depending on natural gas for a lot of their industrial production. And clearly that will suffer to be competitive. Producing ammonia, it's much more competitive now to do in United States or in Asia. We're still using coal to produce ammonia, for example, in China. So part of the chemical and production in Germany, and even steel production, will be under pressure, I think, due to the cost of the energy and the feedstock.
If we look to Asia, Jarand, and China, as you just mentioned, but now the potential for greater competition between Europe and Asia for LNG, for example, I'm wondering your thoughts on what impact that will have going forward on energy flows as Europe moves into the global marketplace for more global gas.
No, the net effect will, of course, be higher gas prices over the next 5 years, which is also speeding up the move away from gas as a feedstock, because, of course, people want to optimize or lower, minimize the cost of the energy they're using. And for quite some infrastructure, you have options as alternatives to gas. So, of course, it could see short term, it's good for the gas producers to get even more cash in a way. but longer term, it will curtail the gas demand actually faster, as you implicitly indicate also, I think, with the very high gas prices we are likely to see for the next few years.
I mean, like Europe, Asia has really has a lack of investment into the infrastructure for gas, very little permanent LNG regasification facilities, a lot of floating, no storage. Do you think this will be a time, okay, the last decade when prices were cheap, it didn't happen, that investment, that in the decade ahead, that sort of infrastructural investment in Asia will happen?
Yeah, I think so, because you know, as you say, that for the winter supply, you have the big price fly-ups in Asia because they have so little storage. Europe has actually a lot of storage and are used to use gas in the winter, and they will further both fill up more of the storage and take down consumption, and are likely to manage, I think, through the winters, even with less Russian gas going forward. But I think also Asia will increase their investments in subsurface storage. They have some opportunities also to do that. So you're right in that. But of course, this market will be balanced in 3 to 5 years, more balanced, and so if the investments are too heavy, maybe it will not even generate a good enough return. So everything is about the short cycle now.
What about China? What's your current short cycle outlook for China? Clearly, it's going through a kind of a very bad COVID moment, as the US and Europe did 6 months ago, a year ago. What's your outlook for China from an energy demand point of view, obviously?
Yeah, I mean, in one way, luckily for the global energy balance just now, we have seen demand going down due to the lockdown situation they have, by the way, which is not really needed because Omicron is you know, a much less benign, malignant virus. So it's actually a benefit to get the population to get through it, as it protects against other versions. So they would benefit a lot to actually change COVID policies, but that's another topic, of course. So I think luckily for the global balance, is cooling it down a little bit now, avoiding the big price fly-ups that we could have had. But of course, it's hurting the Chinese economy much more, and maybe they will change policy, maybe they will realize this, and then we might have a new hike in energy prices. So I think we will have a volatile price picture basically over the next 6 months based on the events that we just talked about.
We'll just wrap up with the kind of more difficult, but yet perhaps the most impactful for the energy markets, the oil markets, is how much oil will be disrupted coming out of Russia? It seems so far not a lot, but some. We still don't have Europe decided yet, consensus on an oil embargo. On the demand side, where do you see Russian exports, how it's affected in the coming 6 months, 2022?
No, I think our base case is that we will have a net destruction of demand for Russian oil of some 1.5 million barrels per day. It's a risk that it could be higher if the embargo will be even more efficient. But of course, and that is especially what, like I mentioned, to the refineries in Hungary and Slovakia. Then there's no other place for that oil to go, but also these refineries will struggle to have alternative oil. So it's really hurting those societies extremely if they have to do that, and I don't really see the solution. But if that happens, if we have a decline of 2.7 that we see as the largest, then that will then we will need an oil price of $180 to destruct sufficient demand to find a new energy balance. But that is less likely, and the other oil that Europe will not take, and also the diesel will find other ways to the global market with a discount. You know, it's absolutely, it's $40-50 now in refinery margins for some of the refineries taking Russian oil that Europe don't want. Yeah, it is. So it will find other ways to the market, but not all of it, and it will be delayed. Yeah, so my conclusion is 1.5, and then we need an oil price of between 100 and 130 to find a new market balance. But it will be events and news flow that will, and including the situation in China, that will make this market very volatile, I think, going forward.
Will the European companies subscribe to the requirement to open and pay in rubles and the Russian demand on that issue? Is that still a potential game changer, or will they succumb to that?
I think they will not. Poland and Bulgaria is already cut off since they rejected, but they have other opportunities actually. Poland has also 80% filled gas storage already, and they will manage. And they are very focused on manage, and they will get the Baltic pipe from Norway up and running. Some other countries like Austria, that is also very dependent on Russian gas, they have already an agreement with Russia to pay in euros, and they are to, I think, to Gazprombank, which is changing it internally in Russia to rubles. So in one way, some people can claim that it's paid in rubles, even if it's paid in euros. So I think it's not going to be many other countries that will be cut off from Russian gas of this reason.
Okay. Well, there's so much to talk about, Jarand, but our half hour is up and I don't want to take more of your time, but thank you so much, Jarand Rystad, CEO of Rystad Energy from Oslo, from joining us on Halftime Talk this week.
Thank you. Very nice to talk to you. Thank you.
Thank you, Jarand. Really appreciate it.